Well, this is not what a lot of you guys are going to want to see to start off this week, with Friday's main event being one of significant importance. Honestly, I can't think of any other event that has been this important in maybe years. I know maybe I'm just not thinking of everything, but as we head into the first Fed cut, it is vitally important that things go well. The Fed is not cutting into weakness, or they are not cutting into a recessionary environment. I've explained this to you on the channel for days, if not weeks now. But I got on X today, and look at what I seen from bar chart. A $9 million volatility options trade. A trader or group of traders spent a total of $9 million by buying roughly 350,000 VIX 22 to 30 September call spreads for 25 cents a piece, or $25 a piece. Cents is option terminology if you're familiar with that. But what this actually is you're buying the 22s, you're selling the 30. So max profit is if the VIX is above 30 by this September VIX expiration. They paid $25 a piece for these. Max profit of $800 a piece. That is a $9 million trade that could theoretically, if the VIX is above $30 by the September expiration, would yield $280 million of a payout from a $9 million trade. This is a very short term, very speculative, very, if you will, risk off trade for markets, broadly speaking. And it comes down to this Friday's jobs report. This Friday's jobs report is the big catalyst of this week. This is the big catalyst for Tesla. This is the big catalyst for the Fed. Whether or not we get 25 basis points, 50 basis points, or more than that comes down to this Friday's jobs report. And I'm just going to give it to you straight. The labor market tends to weaken fast when it does weaken. And that's been the main worry. If you take a look at the unemployment rate, and I should preference, that's the thing Wall Street's going to pay attention to. It's the unemployment rate this Friday. We're actually expecting it will fall from 4.3% to 4.2%. But look at the unemployment rate over the past couple of reports. I mean, 3.8% to 3.9% to 4% to 4.1% to 4.3%. Yeah, the last unemployment report went up 0.2%. If that were to happen again, theoretically, and the unemployment rate goes to 4.5%, not fall, but actually go up something large, you're going to see a circuit breaker in markets. You're going to have a 7+% down day on Friday. Yeah. And I'm not afraid to tell you that. And just to be honest with you. Now, circuit breakers, you may or may not have seen these before. The only circuit breakers we have had in recent history is 2020, March, I believe it was 13th, and the 20th, 21st, you had these circuit breakers. This was March 9th when this article was published. So when you fall 7% in the S&P 500, markets are halted for 15 minutes if the drop occurs before 325. At or after 325, trading will continue unless there is a level 3 halt. A level 2 halt is a 13% decline in the S&P 500. Same again here. The markets will halt or shut down entirely for 15 minutes. Gives people a minute to digest things and try to calm down some of the panic selling, some of the margin calls that you get. A level 3 halt is a 20% decline in the S&P 500. I don't think we're at risk of a 13% decline. I don't think we're at risk of a 20% decline. But a 7% decline could very possibly be on the table if this Friday's jobs report were to give you a surprise large move to the upside. Again, part of that is because we're expecting the unemployment rate will actually fall down to 4.2%. But if it does not and it goes up, you're going to be up shit's creek in markets quickly. Now, as I have explained here on the channel, I don't want to cause too much fear because this is obviously not my base case scenario. It's not. But when I come across trades like that I showed you at the beginning of this video, that is what? Over 3,000% return upon that max gain. It really makes you wonder, like, are we going to get a bad unemployment report? Like, could this get really bad coming Friday? And I think that is something we need to be open to. And I do think a small hedge heading into Friday makes a lot of sense if we could get a 7+% down move upon a worse than expected unemployment report. Because, see, the problem is we started getting these recession fears. Markets fell a lot. They fell quickly, fell 1.4% here, 1.86%, 3%. At one point, the NASDAQ futures were down like 6% and some change on August 5th. And then we kind of bounced back August 5th, right? But you fell 10%. We've bounced back aggressively as Wall Street has really said, hey, we're not really going into recession. We still think we're going to have a soft landing. That's the problem. The consensus view is way leaned towards soft landing. If the unemployment rate does rise at all, goes up to 4.4%, no, I don't think you're going to get a circuit breaker on that. Are you going to have a 3-4% down day? Probably. If we get that outsized move, that historical quick weakening in the labor market, that's where you could erase all of this bounce that we've seen in just a day or two of trading. And this trade that I seen just really, take one trade with a grain of salt, right? Don't base your entire portfolio or judgment around a situation off of one trade, but it does make you think maybe someone knows something that we do not. Now, as I was on X as well today, I seen this from the Kobisi letter. It says 90% of U.S. cities saw a rise in year-over-year unemployment rates in July, according to the BLS. Jobless rates jumped in 350 of 389 metropolitan areas last month. Additionally, in 8 large metro areas with a population of 1 million or more, fewer people held a job in July 2024 than in July of 2019. So you're telling me over 8 million people collectively in 8 different large cities are having less jobs now than they were 5 years ago in 2019. Wow. That's not good. At the same time, average weekly wages dropped in 43% of the 389 metropolitan areas. Now, average weekly wages is a fancy way of really saying two things. Either your hourly rate or salaries are getting reduced, or hours worked is dropping. So I would argue it's just hours worked that are going down, and that's probably why you're getting this 43% reduction. In 5 of the 8 highest paying areas with average weekly wages above $1,400, salaries declined year over year. Ugh, that's not good. Okay. And I think part of the problem with government data right now is it's not necessarily rigged or cooked, in my personal opinion. I don't want to get Google mad at me or YouTube mad at me if I speak negatively about the government. You know how they do not like that. So I'm not going to go out and say that because I don't have enough proof of that. But I can definitively say the data is severely lagged behind. There's a 3 to 6 month lag on the data that we're getting. So I don't really care what happens to the unemployment rate. If it does fall, if it does come in line with expectations and does actually fall, that doesn't really mean shit to me. Because what I see now in the economy is worse than what I seen 3 or 6 months ago. And I think with that lag will come worse data. And I'm more concerned about October to a lesser extent, but really concerned about November, December. By the end of this year, the holiday season, people are already tapped out, let alone You throw holidays in there, and yeah, we're not going to be looking at the greatest situation. Q1, Q2 of 2025 are also going to be pretty bad as well. So in my personal opinion, I'm really not worried about this Friday's jobs report because I think the data is so lagged behind. But if I am wrong and that unemployment rate does rise unexpectedly, like we've seen the rise in the unemployment rate the last 5 months, and specifically last month, that really started to accelerate. You've seen a larger jump last month than the 0.1% increase. It was 0.2%. If something like that did happen again, there is a lot of risk for markets. Now, with my base case assumption of the data coming in line with estimates, we're expecting the unemployment rate at 4.2% to fall. We're expecting non-farm payrolls to come in at 163,000. I think you actually get a rally off of inline data, okay? So that's my base case. And I actually think September's going to be a pretty dang good month for Tesla, for small caps, for interest rate sensitive names. I think the soft landing narrative will probably grow even stronger in September. And that's what's going to dictate how markets react or trade in September is this Friday's jobs report. We also have ISM services PMIs that are expected to strengthen a little bit on Thursday, 10 o'clock in the morning. But what's more important is the ADP employment change. That's the private payroll number, not the government numbers, expecting 115,000 job ads there. If this comes in low, then you're going to spark fears for Friday's report from the BLS, the one that the markets really pay attention to, and that would be problematic. You're also going to get the JOLTS job openings Wednesday, and I think this is really a barometer of economic activity more than it is the actual labor market, because if you're a business doing well, you're going to look to hire more people. If you're not doing well as a business, you're not going to be hiring as many people. So if you see a big drop for the JOLTS job openings Wednesday, that's also going to be problematic. If you see things stay stable, that's pretty good. And markets are going to try to take every cue possible from each of these data points to fit their narrative for Friday's jobs report. If JOLTS job openings fall, people are going to say, ooh, that jobs report Friday is going to be bad. If they come in okay, people are going to say, yeah, jobs report's going to be just fine Friday. I don't necessarily think that's the case. I don't think you can extrapolate these data points to mean that the Friday report's going to be all good or all bad, but that's what markets are going to do. And it wouldn't surprise me if we actually get a little bit of selling before the Friday jobs report. It wouldn't surprise me if tomorrow, if Wednesday, if Thursday are actually negative days overall, risk off days, just because of how big the data is, the catalyst is on Friday. Now, for anyone that's in Tesla, I think this becomes even more dramatic because Tesla is very cyclical, very sensitive to interest rates. It has a high beta and could be a high alpha if it starts to outperform. But if markets have a risk-off event, if this Friday's number is bad and the unemployment rate comes in high, Tesla stock is going to sell off a lot more than other stocks. Okay, and I had some people ask me in the last video, if we do ultimately go into recession, how low could Tesla go? And it depends how deep the recession is, who is the target area of the people getting laid off. And I'm sure there would be layoffs in blue collar, white collar jobs, but I think a lot of those layoffs would be in the blue collar jobs, would be in manufacturing, in manufacturing investment activities. I think a lot of people are going to put off building that new restaurant or building that new, factory or whatnot. You're even seeing Intel do that. They got, $10 billion or so from the government, for an example. Volkswagen right now is looking at closing some of their factories over in Germany. I think some of these jobs would be on the chopping block. I think some low-income jobs, just to make matters worse for low-income people, would be on the chopping block as well. I think you've kind of already seen those software layoffs. You've already seen those tech layoffs. A lot of the people that are typical buyers of Teslas already get laid off. So it would really depend how the recessionary aspects of this economy transpire or transform. But I think it would be people taking the lion's share of the layoffs that were never in the market to buy a Tesla anyways. It'd be restaurant workers. It would be, you know, excess workers at grocery stores, right? At Walmart. It's just companies cutting back those low income earners that they didn't really need in the first place, that they kind of just had there to have there. Okay. So I think that's important. Now, as far as where Tesla stock could go, sub $100 for sure. Like maybe 80, maybe 60 in a really bad scenario. Is that the base case scenario though? No. I wouldn't expect some kind of deep recession to last multiple years in that aspect. But when the fear does come, ultimately, you will fall materially lower than where Tesla is today. But I do think in the near term, Tesla stock could easily hit at $300 per share. Easily in September if this Friday's jobs report is good. And that's my assumption. That's my base case. I think by the end of this year, by Q1, Q2 of 2025, that's really where you want to be a lot more vigilant and, you know, potentially concerned. So these are some of my thoughts. This is the biggest week of really the end of this year because it's all about why the Fed is cutting rates. Because, you know, the economy is okay and they're just trying to normalize policy before they make an error, or did the Fed already make an error? Did they already push this economy too hard? I think the answer is they already made an error. They already pushed this economy too hard. Neutral's 3% on the federal funds rate. Fed's at 5.25% with a weakening labor market, with the consumer feeling like crap. You can see this in the data. Delinquencies on cars, almost at great financial crisis highs. Delinquencies on credit cards past 90 days, way past great financial crisis, recessionary levels. So yes, they've already made the error. The data's not going to pick that up though for a couple of months. So I think we are in a little bit of a sweet spot. Some traders are speculating, though, that this Friday's jobs report could be a big risk-off event for markets. And I think you needed a heads up on that because if we really did get a big fall like that, hedges are cheap and could make sense to throw out a couple hedges. I'm not a financial advisor, not your financial planner. At least take this with a grain of salt. Okay, that's I guess the furthest advice that I can say. Take it with a grain of salt. Do what you guys want to do. Nonetheless, you guys enjoy the rest of your day. Let me know your thoughts on this down below in the comments section. Enjoy your Labor Day and get ready. Winter is coming. Not just for markets, but for literal snow to fall from the sky. If at least you're in Michigan. If you're somewhere else, then don't worry about it. You guys have a great rest of your day, and I will see you in the next one.